Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, I want to get into sort of some headwinds really in the environment. So we've had a Fed rate cut, 50 basis points, 0.5%. That's obviously a big positive, and the hope and expectation of more. And in a lot of ways, that sort of reinforced this idea that we're headed for a soft landing, number one, and number two, that we're on this trajectory to sort of support elevated stock prices, so equity prices, and maybe see a little bit even more positive movement in the equity market. But in this episode, I want to actually kind of come at it from a different angle, really more globally, and identify honestly some risks to that soft landing here in the U.S. and the potential for drivers of a weaker equity market. Just to kind of touch on it. And almost like keep it in our focus, right? We it's great to talk about the tailwinds and things that might be going on, but at the end of the day, we've got to keep a broader focus and make sure we understand what's happening around the world. So anyway, let's start with essentially military conflict. So we know that there's Russia-Ukraine. We know that there's Israel, both with Hamas and Hezbollah. And in a lot of ways, what we're looking for, there's the human cost of that, of course, which is horrible. But when we're coming at it through the lens of the economy and the markets, it really comes down in a lot of ways to both the nervousness that people have about escalation risk, but also the practical reality that's the Middle East is sort of where oil comes from. And so the idea that we see sort of increased military fighting, so escalation of these wars could certainly put sort of a crimp on supply, and oil prices could go up. And of course, oil prices feed a lot of costs that ultimately translate through to inflation. So the punchline here is, hey, we have to be mindful that Israel and Hezbollah, for example, are fighting what really is a pretty intensive aerial campaign. And there's talk of can we have a ceasefire, that kind of thing. But ultimately, the fears are really that could become another ground offensive, right? And that would be escalation. Obviously, Hezbollah, the view is they're backed by Iran, so Iran could get involved. What does all that mean? And in fact, speaking of Iran recently delivered to Russia some close-range ballistic missiles. So you have Russia arming for Ukraine, but Ukraine also reporting that it's created its own ballistic missiles. And so, that idea of sort of an increased form of exchange with honestly farther distances, right? So the idea that even that a Ukraine missile could reach Moscow, it sort of ups the ante a lot. So anyway, long story short, of course, markets would not do well if we had an unfortunate serious escalation in these wars. And again, there's the nervousness of it, but also as it relates to the region, especially with sort of the Israel conflicts, essentially the risk that oil prices go up and that sort of in and of itself triggers higher inflation, which would slow the Fed down in terms of rate cuts, et cetera. So that's a meaningful kind of risk that we're keeping an eye on. A second dimension, which kind of in some ways goes the other way, is actually around economic slowdown. So let's start with China. In China, basically, they've set a target for this year of a GDP growth rate of 5%, and it now looks like they may not hit that. So the government there has actually implemented a stimulus package. And so we'll get into that. But in terms of what we've seen, one of the other sort of forces that we're seeing there is deflationary pressures. So think of it as a measurement of economy-wide prices. The GDP deflator has actually fallen for 5 straight quarters. So think of it as falling prices, where then the consumers might sort of say, wait a minute, I'm going to stop spending because I'm going to wait for prices to go down further. And in an odd way, that whole thing could be a spiral that really slows the economy down. And then finally, there's real pressures in what has been a really government-sponsored property market. So anyway, back to the stimulus package. Basically, think of it as three legs. The liquidity measures, which really come down to lowering rates and lowering bank reserve requirements, number one. Real estate measures, and the gist of that is to lower the borrowing costs on mortgages to the tune of over $5 trillion. And then finally, equity market measures, both borrowing facilities and cash, that ultimately are there to support stock purchases and kind of keep stocks positively supported. And so, the bottom line is China's slowing, and they're trying to take action to negate that, but we'll see if the measures are enough to do that. And then finally, as it relates to slowing economies, if we look into Europe, basically Germany has slowed down, and in fact, in the second quarter declined, its GDP declined 0.1%. So there's pockets of strength, like Spain was up, modest strength. Spain was up 0.8% in the second quarter, but Germany, which is a big economy there, has been in contraction. More importantly, I think, in a way, when we look at the S&P Global Composite and manufacturing Eurozone PMIs, they're both below 50. So take, for example, the manufacturing PMI. It's a Purchasing Managers Index. So survey of business leaders. Basically, it sits at 44.8. 50 is the level of neutrality. Below 50 means contraction. 44.8 means pretty serious contraction. And again, these are leading indicators for the economy. So that data has gotten people's attention. Now, people might say, well, that's happening over there, or it's happening in China, and maybe that doesn't bother us. But number one, I'd say the two are interrelated. So Europe and China are sort of, active trading partners. So as one slows, the other might be impacted, and vice versa. But also, really, when you look at something like the S&P 500, as an example, roughly 8% of the revenue from companies in the S&P 500 actually come from business in China. When we zoom in on the Magnificent Seven, 5 of those stocks have revenue that's 10% or more of their revenue comes from China. So a slowdown in China can be a headwind to our markets. And so obviously that's why we wanted to sort of highlight that. In any event, again, I think overall our base case continues to be that we're headed for a soft landing. We want to see that inflation remains under control. We want to see further cuts from the Fed. But we have to be mindful that there are risks to all that. And notably in this case, the risks of escalation in the military conflicts, and then also basically a significantly slowing or contracting economy in other countries and regions around the world. So listen, that's what we wanted to cover in this episode. Thank you so much for listening, and we'll catch you next week. Take care.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.